There's a $100,000 pickup truck in your office lot right now. Its owner isn't some car enthusiast, he's a CEO. That truck just helped him write off almost the entire purchase price. He did it against his tax bill in the very first year of owning it. Sounds absurd, right? The IRS, the agency that collects federal taxes, actually allows this. And it's completely legal. It's written right into the tax code. This video isn't really about trucks. It's about one number buried in the tax code. Almost no salaried employee has ever bothered to read it. That number is vehicle weight over 6,000 pounds. Just that one number splits the world into two groups of people. One group pays their full tax bill. The other group knows how to delay it. Before we talk about money, we need to talk about one specific spec. GVWR stands for Gross Vehicle Weight Rating. It's the maximum total weight a manufacturer allows a vehicle to carry. That includes the vehicle itself, passengers, cargo, and fuel. You won't find this number on any marketing website. It's printed on a sticker inside the driver's door frame. After a few years, that sticker often gets hidden by a floor mat or dust. The IRS uses that exact number on the sticker to classify a vehicle. Say the GVWR is 6,000 pounds or less. Then it's treated as a regular passenger car. That triggers depreciation limits under Section 280F of the tax code. People in accounting call this the luxury car limit. In 2025, that limit caps the first-year deduction at one fixed amount. That amount is $20,400. That cap applies no matter how much the vehicle actually costs. A $100,000 Mercedes S-Class only gets that same deduction. But if the GVWR goes above 6,000 pounds, everything changes. The vehicle steps outside the passenger car category entirely. It enters a completely different world. And in that world, the $20,000 cap no longer applies. This isn't some hidden loophole either. It actually had its own nickname in American business accounting circles. Back in the early 2000s, people called it the Hummer loophole. That's because plenty of small business owners bought Hummer H2s. They did it specifically to take advantage of this rule. In 2004, Congress passed the American Jobs Creation Act. That law set a separate cap for heavy passenger SUVs. The original cap was $25,000. That cap still exists today. It only gets adjusted for inflation year by year. Now let's get to the real numbers, straight from IRS guidance for tax year 2026. The total Section 179 deduction limit for 2026 has a specific figure. That figure is $2,560,000. That applies to all qualifying property a business buys during the year. This limit starts phasing out once total purchases pass a certain point. That point is $4,090,000. It disappears completely at $6,650,000. This comes from the One Big Beautiful Bill Act. It was signed on July 4, 2025. That law doubled the previous cap. But heavy passenger SUVs follow a different set of rules. That category covers vehicles weighing over 6,000 pounds. It goes up to 14,000 pounds at the high end. Section 179 caps the deduction at one specific amount for those. That amount is $32,000 for 2026. The remaining amount isn't wasted, though. It shifts into a separate mechanism called bonus depreciation. That's currently set at 100%. It applies to property bought and placed into service after a certain date. That date is January 19, 2025. That rule also comes from the same law just mentioned. Put both mechanisms together, and here's the real math. Say a business buys a $90,000 Cadillac Escalade. Its GVWR is 7,400 pounds, and it's used 100% for business purposes. Section 179 deducts $32,000 right away. The remaining $58,000 works differently. It qualifies for 100% bonus depreciation. The total first-year deduction comes out to $90,000. That's almost exactly equal to the price of the vehicle. Now compare that to a salaried employee. Say that employee buys a Mercedes S-Class for $90,000. They pay with personal funds just to commute to work. They get zero deduction. That's because a personal vehicle isn't a business asset. Same price tag, completely different financial paths. And the difference comes down to one line on the vehicle registration. It's whether that line says an individual's name or a company's name. So which vehicle actually crosses 6,000 pounds? And which one does not look the part at all? The Ford F-250 Platinum has a GVWR over 10,000 pounds. That makes sense, since it is a heavy-duty truck. But the GMC Yukon Denali also crosses 6,000 pounds. So does the top-trim Chevrolet Tahoe. The Cadillac Escalade crosses that line too. So do the Toyota Sequoia and the Lexus LX 600. All of them look like ordinary family SUVs. The Mercedes G-Class also falls into this group. That includes the G550 and the G63. Its GVWR crosses the line thanks to a body-on-frame design. Mercedes has kept that military-style frame since 1979. The long-wheelbase Range Rover reaches a similar threshold. Even a few electric vehicles make this list. Heavy battery packs push their total weight higher. The Rivian R1S often exceeds 7,000 pounds. The Hummer EV exceeds 9,600 pounds. Some Tesla Model X configurations touch or exceed 6,000 pounds. That depends on the specific VIN. Buyers should check the actual GVWR sticker before assuming anything. But the price of this deduction is not free. 3 conditions must be met. First, the vehicle must be used for business purposes. That use has to exceed 50% of total time. It does not need to be 100%, but it has to clear the 50% mark. Exactly 50% does not count as qualifying. Second, the business must keep a mileage log. That log needs dates, business purpose, and miles driven. It has to be kept continuously, not reconstructed at tax time. Third, the vehicle must be placed in service by December 31st. That deadline falls within the relevant tax year. The business must also file Form 4562 with its tax return. None of this process is a secret. It is all laid out publicly in IRS Publication 946. It is also in the instructions for Form 4562. The difference between who benefits and who does not is simple. It comes down to who actually reads the rules and who does not. Now let's get into the part most videos skip over. It is not as dramatic, but it actually matters more. This is not free money. It is a shift in timing, not an elimination of tax liability. When the business later sells the vehicle, things can change. That deducted amount can be reclassified as taxable income. This is called depreciation recapture. Say business use drops below 50% too early. That has to happen before the standard depreciation period ends. In that case, the IRS can claw back part of the deduction. Penalties are also possible if there was intentional misreporting. Section 179 is also capped by the business's actual taxable income. A company already operating at a loss cannot use this deduction. It cannot use it to create an even bigger loss. Any excess simply carries forward to the next year. It is not lost, but it cannot be used right away either. And most importantly, this tool is for real businesses. It is for businesses with real revenue and real tax filings. That means a Schedule C, an S-Corp, or an LLC structure. Picture this scenario instead. A company buys a vehicle, but uses it almost entirely for personal trips. Then it claims 50% business use, with no real mileage log. That is exactly the kind of file the IRS flags first in an audit. No CPA would ever recommend doing that. The risk of a later clawback usually outweighs the upfront savings. The core point of this whole story is not some legal loophole. This rule has been publicly available for years. Anyone can read it, and anyone can use it if they meet the conditions. The difference between who benefits and who does not is not about wealth. It comes down to who actually opens Form 4562 and reads it, and who just looks at the price tag and buys on impulse. A luxury vehicle bought with personal money is a pure expense. That same vehicle can be bought correctly through a legitimate business. With clear documentation of its use, it becomes a financial tool instead. The difference is not the vehicle itself, it is the legal structure behind that purchase. So here is a question for you. Say you are running a business and need a vehicle for work. Would you choose a sedan under 6,000 pounds to stay low-key, or a heavy-duty SUV to keep nearly all that money inside the business? Leave your answer in the comments.